Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the related markets that have an impact on the precious metals. Miles, without further ado, let's jump right into this week's charts.
Yeah, thanks, Tori. And we're going to blow through these pretty quickly because we have our regular special guest, Robin, here this week. And we've got a discussion on some long-term pricing and direction of gold that we feel is coming over the next couple of months. So jumping right into gold, following up on our show last Wednesday, gold up 2.6% since the show last Wednesday, forming a little short-term compression after following all the way down to the 618 fib, going back with the rise that we've had, and a potential break actually today. We haven't broken above the resistance level, which is slightly above us around 1950, and then the 382 fib up around 1961. So we're bouncing around the 50% line, 1927. Top end resistance, again, 1950 at least, preferably 1961. Your bottom end support would be around 1895. So should expect to see gold trade within those numbers and looking for a breakout one way or the other.
Yeah, not a whole lot has changed this week in terms of fundamentals, so it's good to see the technical aspect of it follow. You know, one thing that very few people know is gold is at an all-time high in the euro. So you don't always have to get stuck measuring it in the US dollar. That's what we do on the show. You've also got some other things pointing towards those same support levels, Miles. If somebody wants to look at like a 50-day moving average at around 1882, and then sea rise climbs. You know, these sea waves can last anywhere from 6 to 24 months. We're 6 months in, and it's up 20% in that 6 months. So we'll see where this ends up getting a little tired. But thank you for the support levels because, you know, that's important for people to realize. If we keep coming down, right, Rob, where do we bounce from?
Right. Moving over to silver, up about 2.9% since our show last Wednesday, so a little bit better than gold. But silver, not quite the decline that gold saw, where gold came down to the short-term 618 fib. Silver stopped at the 50% line, which also lined up with the high going back to the middle of February at around 2450, and it looks like we're starting to rise up from there. That bounce did come with RSI divergence, as you can see on the chart here, and we may be climbing up from there in a little bit of a wedge pattern. So we are still, just like gold, still well above the 200-day moving average, so there is a little bit of downwards pressure, but your resistance level on silver starts at around 2550. Personally, I'd rather see us up more like 2650, at least most of the way up towards the high back about a week or so ago. And then on the low end, if we were to break below that 50% line, 2450, you could look at a move down to the 200-day or the 618 fib just under 24. So 2450 on the low end, let's say 2550 on the top end, I would say are your breakout point short term.
Yeah, silver has lagged gold in that, you know, sort of sea wave climb, that 6-month little bullish rally that we mentioned on the gold side. And it's lagged, and that's why the ratio is at 77-1, because we had gotten down to 62-1 in the ratio as a low this time last year. Haven't seen it since, and now that we're at 77, what that means to us is that silver actually has become more undervalued than gold in that same period of time, even though like today it's up 1.5%. That to us is something that we think could occur on a longer term basis and consistently outperform gold on a day-to-day basis, which would reward your silver diversification.
Finally, rounding out the metals, let's look at platinum, up about 2.5% since last Wednesday. Platinum, bigger decline since the high earlier in March, 1177, all the way down to the 786 fib at 981. Currently bouncing around the 618 and the 200-day moving average, so it's good to see platinum moving below it, test it, come back above it. Platinum is showing some base building here at around 1,025. Low end support level, again, down at around 980. I'd like to see platinum get above about 1080, maybe 1100 range to argue that we're taking that next stair step up. And given the nature of gold and silver, both looking like they could be moving short-term bullish, it's likely platinum would follow.
Don't let it put you to sleep, right? Get your platinum position. It's also incredibly undervalued.
It is worth mentioning, since all of the metals are up about 2.5% to 3%, guess what else is? The Dow Industrials. I do think there's a line in the sand here worth showing on this chart, somewhere in the mid 33,000 range that we've been both above and below. as far as some both resistance and support. So that's the 500-point range that I'm keeping an eye on between, say, 33.3, 33.9, and it does look like we're starting to inch our way down below that. And of course, all of this is sitting on the heels of the U.S. dollar. U.S. dollar came into that shoulder compression that we looked at going back to spring of 2020. The dollar's off about 1.5 1.2 to 1.5% since last week, and it hit that resistance level from 2020 and now showing compression following beyond that. This looks bearish to me on the dollar. That could just be my assumption, but the dollar is also well above its 200-day moving average. So you could see some declines across the board. However, I still argue I think the metals look a little more bullish than bearish. The Dow and the dollar looks a little more bearish than bullish.
And that coincides with that inverse relationship between the currency against which you're measuring gold and gold itself. And so, still that dollar's at a 1.5-year high. Maybe we get to the 103, right, that it did in 2020, but it's going to take another major event for us to see that. But keep in mind, gold is the real currency. People don't label gold as a currency. And I know, Rob, you're going to get into this here in a little bit about the fundamentals of gold too, but don't forget to measure it that way. And think about everything that's changed here as of late. In terms of your cash positions, for example, a cyber attack or a hack, right? A new digital currency, a conversion to some new currency other than the dollar. We get asked about that. A loss of confidence in the dollar, hyperinflation. Like we're in inflation, but imagine a hyperinflationary emotional event. Freezing of accounts, freezing of assets. All of those are legitimate concerns. Guess what makes you immune to all of them? And it's the gold, right? I mean, it all roads in that instance really do lead to gold. So
here we are. We're approaching the all-time high for gold. In fact, we actually touched it here about a week ago. What has happened over the last 10 years since 2011, when it hit the high for the first time, has created what we have seen since 2011 is what is now classically a teacup and handle formation. And that's 10 years in duration, where gold is back to the same highs as it was in 2011. But what's happened since 2011? All the gold in the world is worth $16 trillion. We have added $16 trillion to our national debt, equal to all the gold in the world. How much gold has been made from the mines? How much gold has been produced from the mining sector since 2011? So while we're adding $16 trillion to the national debt and almost $13 trillion to the money supply, the mining production has only added $2.2 trillion to gold. So gold is underperforming the expansion of debt and money supply. Just here in the U.S., the national debt is increasing 7 times faster than gold production. And in terms of the money supply is increasing by, say, almost 6 times faster. When you look at total global debt all around the world is growing 13 times faster than the mines can keep up with. So the question becomes, and Tori, you pointed this out, it's a loss of credibility, not just politically, not just with the media, but it's a loss of credibility of the central bankers, particularly our central bank. Governor Powell is saying he's aggressively going to be raising interest rates to battle inflation, but at the same time he's saying inflation is only transitory. The money managers aren't buying into that. They're not even buying into the official inflation rate of 8%. It's actually, according to Shadow Stats, using the same formula used under the Carter administration, it's closer to 15%. What that means is for every 100,000 you have in the bank, you're losing 15,000 a year in purchasing power. Gold, the stage is actually set for gold to move dramatically higher, not just approaching its all-time high. And yes, we can be parked here for 3 to 6 months while the longs and the shorts battle it out. But the big money, the money managers, are questioning the integrity of the Fed. Their talk about inflation, their talk about unemployment, their projections for inflation and unemployment are in la-la land. And the money managers know that. At what point do they move aggressively into the only alternative being gold?
That's right. A negative real rate of return. Go get a return on your dollar. you have a real negative return rate right now of 15%. So what do interest rate hikes look like in that type of a reality, which is what you're calling them to the carpet on?
Well, and you raise interest rates, it's almost an exact perfect relationship between aggressively raising interest rates and pushing the economy into a recession. And we are in an election year, midterm year. I don't think the Fed is going to be that committed to raising interest rates while the Congress is being battled over.
I totally agree. And those interest rates are not only politically sensitive, they're very damaging in some instances to the economy. So they have to be careful to try to maintain some sort of semblance of economic viability and health. I don't buy it. I don't see it playing out that way. But a lot to tell as the rest of the year plays out. In the meantime, we'll be keeping our eyes on the charts on a weekly basis.
Yeah, I think the key going forward, of course, is the relative pricing of things. This is why we talk about ratios. This is why we talk about dollar, inflation, M2 money supply. And if you'd like to learn more about any of those and how they affect your personal portfolio, give one of us a buzz here at McAlvany ICA. We're happy to talk to you about your assets and what you can do with them in the precious metals market. We can be reached at 800-525-9556. You can also find us on Facebook at McAlvany Financial or Twitter at ICA Gold. And more info can be found on our website at McAlvany.com.
Thanks for listening. Have a great week.